everyone, and welcome to a very special episode of Going Public. On today's episode, we will be speaking to three personalities from the Colombo Stock Exchange, and they will be taking you through the A to Z when it comes to this process in taking the next big step in the future of your company. On today's show, we won't be speaking about a success story, but we will be giving you the information that you need to make your very own success story. On that note, I'm going to hand you over to the very capable host of our program this evening, Mr. Vasula Premavardhana. He is a capital market specialist as well as a former director of the SEC. Vasula, over to you.
Thank you, Amaya. Today on Going Public, we have a very exciting program. We are going to be discussing the mechanics of listing your company with Colombo Stock Exchange officials who are here with me to do just that. We have Renuka Vijayawardana, the Assistant General Manager of Regulatory Affairs. We have Priyana Gunasekara, Head of Listing and Corporate Affairs. Welcome. And Viduni Velagadara, Assistant Manager Listing. Welcome, Viduni. Renuka, maybe we can start off with you. Give me an introduction into this listing process.
Yes, Vasula, thank you very much for inviting us for the program. Before we get into nitty-gritties, let me highlight to you and our viewers about the vision of the Colombo Stock Exchange first, where everything flows from that. Now, our vision is basically to be the preferred choice for creation of wealth and value. Now, this has different meanings to different stakeholders who are associated with the CSC. You know, the brokers,
right.
listed companies and various the investors.
Yeah.
What applies to the potential issuers is basically this creation of value through the stock exchange. How do we do that? We do that through our listing process. We offer potential issuers a mechanism where they could list their securities, maybe shares and other products, on the CSC and raise capital and create value. Basically, how do we do that? I mean, if you really consider it in a more deeper way, if a company is unlisted, if it is at a private limited liability level, usually there is a discount to the valuation of such a company, because on one hand there's not much information available about the company, then there's no liquidity in the shares. So usually there's a discount. But once the company is listed on the stock exchange, the whole scenario changes.
That's right.
There will be the company will be subject to independent market valuation by maybe broker research, etc. And the company's shares are quoted and starts trading. And when the company's profits grow and the revenues grow, and if there is competitive advantage in the industry to the company, and depending on the growth potential, there will be demand, which is created through the market for the shares.
Right.
And when there's a demand, obviously the value goes up. Value of the shares go up. That's how the value creation happens. And also, as owners, you may be holding a slightly lower percentage after listing, maybe 75% or 90%, but the value of those shares will be much higher than what it was before. Right. So that's how you create value through the stock exchange.
The price discovery process.
That's right. I would like to divide the listing process into three groups. First, the pre-IPO preparation, where the company has to do a lot of housekeeping, a lot of things. I'm sure in privious discussions also things would have been highlighted by the investment banks, etc. How you prepare for the IPO. Then the second stage is your communication with the CSC, sending the application. That's what we are going to discuss in detail. The interaction with the CSC until such time the approval, in principle approval, is granted by the CSC. That's the second stage. Third stage is actually the more exciting period, where you go to the public, issue prospectus, raise funds, etc. and ultimately list the company, and the company shares start trading. So there are three regimes, but I must tell you the most important the most important period of this is the first one, preparation for the IPO. There's a lot of work you have to do. So in a nutshell, that is the whole listing process.
Brilliant. So obviously at the preparation bit you all are giving advice, of course, but actually it's a more internal process that the company itself has to undergo.
Yes.
And actually we have covered that quite a lot with various companies, and they have told very interesting stories from not so difficult to difficult, but generally I think it's about 6 months to 1 year.
6 to 1 year.
Yeah,
6 months to 1 year.
That we have come up with. So what are the key requirements as you would
Yeah, considering the requirements to get listed at the CSE, we actually have two boards for listing of equity, the main board and the Dirisavi board. If a company wishes to get listed on the main board, they have to have a stated capital of 500 million. This 500 million could be achieved including the IPO quantity, so it's at the time of listing that they have to have the 500 million. Then also they have to have positive net assets for the immediately two preceding financial years, and the positive net assets will be as per the audited financial statements of the immediately two preceding years, and if it's a parent company, it will be based on the consolidated audited financial statements. And that company also has to have profits for 3 years, for the immediately 3 preceding years, based on the audited financial statements. And there again, if it is a parent company, it has to be as per the consolidated audited financial statements. Then another factor is the public holding. The company has to have a 25% public holding to be on the main board, and this 25% has to be in the hands of 1,000 public shareholders at least, holding 100 shares each. Those are the basic requirements, and of course the 25% can be waived if the public holding is so large enough to have a liquid market, and the CSE is satisfied that it's adequate for a liquid market. And then coming to the Dirisavi board, the stated capital is 100 million. The requirement for stated capital is 100 million. There again, you can include the IPO quantity to arrive at the 100
so
million.
So it can be 50 million, another 50 million, your 100 million, you can get on the Dirisavi board. Is it right?
You have to have an operating history of 1 year, which generally means that you have to have an audited financial statements for 1 year.
Right.
You have to also have positive net assets for 1 year, and a 10% public holding. And this 10% public holding has to be in the hands of 200 public shareholders. So that is for equity listing on the main board and the Dirisavi board.
Right. So that's very interesting. So actually you have facilitated the Dirisavi to allow the smaller companies to come in. But do you find that also larger companies entering there? Is there a maximum that you have to jump to the main board?
No maximum.
So even Goliath can come, a big company with 500,000 billion rupees can enter through the Dirisavi if they wish to. So what's the advantage for big companies between the main board and the Dirisavi board?
You can't call it an advantage, but of course if they don't have the public holding, maybe if their public holding percentage is lesser than 25%, maybe they can first come into the Dirisavi board and then migrate.
Also, actually, the Dirisavi board is more or less for the SME sort of, small and medium sector. Of course, you have to have 100 million.
To encourage the smaller companies.
That's right.
Not to encourage the bigger companies to come out with 10%.
It's their choice though. Right? Because once you are listed, whether you are on the main board or the Dirisavi board, the obligations are absolutely the same. Earlier there were some differentiations, but now we have removed it. It's the same.
So other than that's why I was trying to come with what you were saying. The bottom line difference is the 10% that you have to
maintain that.
So maybe somebody who is big might want to not give 25%, and then they can step into the Dirisavi. Is there a capacity for any company to get bumped up a couple of years later?
Yes, of course.
Okay.
Of course. They can migrate to the main board from the
Provided you meet that listing, then of course you just kind of migrate to the board. You don't have to do any other.
No, they just have to
meet the criteria,
convince
and then
that to the stock exchange, and we can promote migrate the right.
So, what else can you say about the methods of listing, the IPO stage, the introduction? Well,
as I said earlier, during the pre-IPO stage, if they are very well prepared, it makes the whole process a lot more faster, a lot more efficient, and a lot more easier for everybody. CSC, the investment bank concerned, and the issuer. If I may give an example, once you send an application to the CSC, if there are no serious issues, usually within about, I would think, 2 to 3 weeks, you could get the approval. If everything is in order. In principle approval. Right. But of course, there have been times where the process can get dragged on, depending on the issues that can arise.
Right.
Mainly, the more serious issues are relating to the financial statements actually.
Okay.
That's where you might need to sort of go back and even redo sometimes in rare scenarios you might even have to revisit your audited accounts, because if it is not in a stage where it's not in terms of a listed company, it may not be that suited. But other than that, the disclosures usually, if you are very well advised by an investment bank, the process can be very faster.
Okay. So between the equity and say the debt listings, can you talk about the debt listings a bit?
Yes. There are two boards for debt as well.
Basically, if a government body or a public corporation is issuing the debentures, they have two options. One is they can give a guarantee for their debentures. Here the guarantee has to be given by the government of Sri Lanka or by any bank which has an A rating or by any other agency acceptable to the CSE. The other option they have is they can give an investment grade rating for their debentures. Next, if you look at a company listing their debentures, they have to only satisfy one key requirement, that is they have to give a rating for their debentures.
So if you come up with, just to go back to the debentures, because I think we've spoken to a lot of companies and I think our viewers are more familiar with the equity because we haven't touched on debentures, debt listings that much. So what is the criteria for, other than you say you're not a listed company, but if you are an unlisted company coming and trying to list a debenture, then what are the disclosure requirements?
Disclosures, like basically with regard to shares and debentures, it's the same disclosure. Depends on what is the main document that you're going to use. Like if you're coming for an IPO, then you've got to use a prospectus, and then in the prospectus obviously you've got to say details about the company, what they're doing, because it's first time coming to the market, and also because money is raised in an IPO, you have to tell the public what you're going to do with this money. And like if you're having 2-3 purposes, you can give a breakdown as to how much you're going to use for each purpose. Next, you've got to give some information about your shareholders, directors, corporate governance practices, underwriting. Of course, underwriting is not mandatory, it's optional. With regard to financial statements in a prospectus, you've got to give audited for 1 year, interims which are not more than 3 months, and summarize for 5 years.
Right. Then during the period that is post listing, then what are the requirements of a company?
It's like this. Now, just because you list a company doesn't mean your obligations to the market ends there. There are two types of obligations actually. But whatever the way, if you can be a listed company by listing shares or by listing debentures. One, there are certain routine requirements like release of the annual report. There are timelines given within 5 months from the end of the financial year. Then there are these requirements like releasing quarterly, unaudited quarterly interim statements. There are certain timelines given for that also. Then there are various other routine requirements like disclosure of appointment of directors, resignation of directors, and also the directors' transactions will have to be disclosed. There are routine disclosures like that also.
We will come back to this topic again. I think it's time for a break. We will be back shortly. Welcome back to Going Public. We are here today with the stock exchange officials, and we are talking about the mechanics of listing your company or even debt on the Colombo Stock Exchange. Renuka, I think we were on the topic of continuous obligations for a company.
Yes, we briefly discussed about the routine sort of disclosures a listed company will have to make to the market, and the other aspect is this price sensitive information. Once the company is listed, any information which has a bearing on the share price of the company, we call it material information or price sensitive information, has to be divulged to the market through the stock exchange immediately. That's the second aspect of it. We can discuss these things in detail.
Yeah.
I think we need to go back to the initial listing process, Vasula, because we need to understand how a company can get a listing. In fact, there are 3 methods of getting a listing. We spoke about the IPO process, you going to the public and raising money. IPO, that is public subscription of shares, that is the company creates new shares, issues new shares to public. So that is usually referred to as IPO. That's one very popular method of getting a listing. Second method is offer for sale. Now, offer for sale scenario also, there is a public issue, but the company doesn't create any new shares. Usually what happens is the major shareholder, who may probably have say 100% or 75%, will divulge part of his stake to public. The difference between offer for sale and offer for subscription is that under offer for sale no new shares are created, but the public issue element is there for both cases. The third one is a very interesting method, that is getting a listing through introduction. you don't issue any new shares. There's no public offer, nothing. Company is there. Company is a public company which meets our listing criteria. You can get a listing as it is. So probably Priya and Miduni can go into details of these things.
Yes. We have a slide also on the timelines for
I think our viewers can see it on
the IPO process.
Right.
Yes. As we spoke earlier, the company has to be in readiness when they come for the IPO to get their company listed. And as Renuka explained, the CSE approval process will take time depending on the quality of the document. Once we give the approval, the subscription list has to open within 20 market days.
Right.
And however, the prospectus has to be in the hands of the investors 7 market days before the opening of the subscription list. After the opening of the subscription list, the offer can be kept open for 14 market days. But however, if the offer is fully subscribed on the first day or second day or third day, whatever, depending on that, they can inform the CSE and close the subscription list. And after they close the subscription list, they have to attend to the refunds and the CDS uploads. The refunds have to be made within 10 market days. And if they don't make the refunds within 10 market days, there will be some penalty interest to be paid. And the CDS uploads have to happen within 18 market days. Once the CDS uploads happen, a declaration has to be sent to the CSE informing that all the requirements have been complied with. And within the next 3 market days, the company can get listed and the trading can commence. Then if we go to the introduction process, it's a very simple process. Approval is same as before, like in IPO. It depends on the quality of the document, and the CSE will grant approval. Here again, once CSE approval is granted, within 20 market days, the introductory document has to be issued. But of course, it has to be in the hands of, the soft copy has to be in the hands of the investors for 7 days before. And along with the introductory document, the CDS uploads also have to be done. And once the CDS uploads are done, the following day, they will send the declaration that all the requirements have been met. And again, within 3 market days, the company can get listed. So if we go into the statistics of the recent past, we have taken 5-year statistics. Within the last 4 years, 28 companies have got listed at the CSE via equity IPOs. But this year, we have listed 2 companies already, and 3 companies are in the pipeline to get listed already as at March. Now, this is, I think, mainly due to the tax concessions that are being given by the budget proposals. In the 2013 budget proposals, they proposed a tax concession where if a company gets listed and maintains a public holding of 20%, the effective tax rate is reduced to 50%.
Right.
And if you continue to hold that public holding of 20% for the 3 consecutive years, then for 3 consecutive years you get this 50% tax reduction.
Right.
And now in the budget proposals of 2014 also this same tax concession has been extended. However, it's not in gazette form yet, but in the proposal form yet, but I'm sure it will get gazetted. So I'm sure we're going to see many more IPOs in the near future.
Certainly.
And equity introductions, of course, introductions are not very popular now mainly because on 1st of April 2012 it was suspended. Introductions were suspended, but we reintroduced it from October 2013. But since the IPOs have the tax concession also, I guess introductions won't be the tax concession is not applicable to introductions.
Just let me ask a question now. Why was the introductions not allowed and suddenly brought back again?
Well, at that time, we felt that certain requirements that need to be met by companies are not being met when they list via introductions.
So,
there were very good question, Vasul. I think there were reasons as to why the regulators, the SEC mainly, and the CSC suspended the introductions. As you would understand, in an introduction, there's no issue of shares. So, there's no price discovery process created. The companies there, you just get a listing as it is.
That's right.
Sometimes there were instances where some companies with a very thin public float, the share prices were increased dramatically, and the analysts found it very difficult to understand what the reason was. So the price discovery process was not very transparent. That was one scenario. Second one was this public float. There were instances where some companies got a listing on the CSE through introduction on the Dirisavi board with 10%, but there were lots of shareholders owning just about 1.1% to 1.5%, and in the public component there was one shareholder owning about 8.5 to 9%.
Right.
So the real public component was not very liquid in that sense.
Right.
Now we have reviewed that situation, and we have reintroduced introductions with certain new restrictions.
Conditions. I see.
Now
okay.
to answer those issues that we would have had, now under the new method, the top 3 shareholders can only go up to 50% of the public float. Now, for example, if a company wants to get a listing on the Dirisavi board through a introductory methodology, major shareholder can have 90%. The public has to have 10%. Now, you can't have in the public component, the top 3 can't have more than 50%. So it has to be fairly spread out.
Right.
So that enables liquidity creation.
Right.
Then there is a new requirement where the introduction, there's a reference price has to be very clearly set out in the document, and the basis has to be given with a fairness opinion by independent party. So it was reintroduced with some restrictions like that. So hopefully we'll see, because it's a very fast and very efficient way of getting a listing. You don't have to go through the hassle of IPOs.
Yes. IPO so it had disadvantages, but also I think you have plugged the holes, and now you have a better process that is going to come.
Correct.
Yes, you were saying.
In going to the debt IPOs within the last 5 years, actually last year we saw a very significant increase in the debt IPOs, where we had 28 debt IPOs last year. Most of these debt IPOs were from already listed companies. The main reason for these debt IPOs was once again a tax concession that was given by the government. If a company listed its debt through the CSE after 1st January 2013, the interest and profits earned from such investments will not be subject to tax. So no withholding tax. So
profits earned from the money raised from the debenture is actually
for the investor.
For the investor.
Interest and profits.
Coupon payments.
Right.
Interest and profits.
Interest free on the coupon payments. Okay.
Will be exempt from.
So the anomaly between the corporate bonds and the government bonds, there was an anomaly. The notional tax was applicable for corporate. Now it has been abolished, and all of a sudden, last year you would have seen there was a surge in corporate debt. That's the primary market.
And through these 28 debt IPOs, we raised 68 billion, a record amount.
That's right.
Last year, and already we have got 5 applications in hand. So I'm sure this year too we will see a lot of debt applications.
So you're actually seeing that a lot of people are listing their debt, and also a lot of people are going away from perhaps treasury bills and then coming into the market.
Actually, from our experience, the investor segment that goes into corporate debt is not as same as the investors who would go on for equity. They, as you said, they are into debt. They are into maybe treasury bills and bonds.
Right.
So we see that they are shifting from the treasury bills
because
to this.
For the longest time, we didn't have the corporate bond market here in Sri Lanka.
Speaking of corporate bonds, Fasil, there are distinct advantages in listing corporate bonds vis-a-vis listing equity also.
Right.
To the issuer. Now, for example, what is the other option? You go to a bank and apply for a loan.
That's right.
So the option that we make available, we provide through the stock exchanges, list your corporate bonds.
Precisely.
If you go for a bank loan, the tenure is pretty short. It can be about 1 to 5 years maximum. Right. But in a corporate debenture, it's much longer than that. Right. You can even structure it for 10 years. So that's one facility. Then there's no collateral required. You go to a bank, you have to give collateral. In a debenture scenario, there's no collateral.
Yes.
And one major advantage is actually the cost of capital to the issuer is lower when you list debentures, provided you have a very good rating.
Right.
Higher the rating is, lower your borrowing cost. So it's a huge advantage. And also now once you list your debentures, and if you continue to get good ratings, you can always go back to the market. You have seen a lot of companies doing that. I mean, especially the big banks, they have always done it. You can always we can keep going to the market and raise more capital at a reduced cost.
Right.
So these are huge advantages to the issuer company.
That's right.
And vis-a-vis equity, equity investor actually usually expects a premium on the valuation, because he's holding on to the shares. There's a risk attached to it. Vis-a-vis debentures, the risks are pre-identified. You know that what is the risk, the maturity payments and the periodic coupon payments. So there's more definite risk horizons available to the investor also.
Right.
That's a very popular method.
That's right. The process of disclosures in prospectus.
Prospectus, basically what I said initially, with regard to the introductory document, the rules itself identify two scenarios. That is, if a listed company is going for an introduction, then there is minimum disclosure, because all information about the listed company is already available on the CSE website. But if it's not a listed company going for an introduction, it's a first timer, then again they've got to give out information about the business carried out by the company. Also with regard to shareholder information, directors information, corporate governance, and reference price. The reference price is the price at which the shares of the company will commence trading. So this price is decided by the company based on a fairness opinion. CSE does not get involved. The company has the power to decide on it. With regard to accounts in an introductory document, they've got to give audited for 3 years and interims.
It's time to go for another break, and we'll be back on a very interesting topic on going public with the stock exchange officials. Welcome back to Going Public. It's a very interesting program today. We are here with the Colombo Stock Exchange officials talking of the mechanics of listing your company. Renuka, we were talking about the prospectus and the initial listing period. Well, maybe one question I want to ask is, this is lock-in process, initial lock-in period. Who's going to talk about that? Yeah. Can you explain that to us?
Yeah.
Yes.
Companies that get listed are subject to a lock-in, and it happens in this way, where if the shares have been allotted 12 months before the listing, then such shares held by non-public shareholders will be locked in for 6 months. But even if the shares have been allotted before 12 months, if it's public shareholders, there is no lock-in involved for public shareholders, and the public shareholders are defined very clearly.
We're talking about a second issue. If it's IPO, of course, then your locking criteria, there are no public shareholders, right?
You could still have public shareholders.
Okay.
Yeah, you could have.
See, non-public shareholders are usually the directors, the related parties, the parent companies. But you could always have independent, unrelated people holding shares even before listing.
Angel investors who come in.
Because if you take an introduction,
so they are in the non-public.
Yes.
Okay, that's one.
So if you take an introduction, all the public holding is there beforehand, before they list. So the lock-in for the introductions is also very similar as for the IPOs. And then if there are any transfers made within a period of 12 months, such transfers will be locked in for a period of 6 months from the date of listing, or 12 months from the date of allotment, whichever is higher. And if there are any allotments within 12 months, you'll have to get SEC approval as to whether lock-in is applicable or not. So that's the lock-in rules that we have at the moment.
So we did discuss about the pre-IPO period and the initial listings, and we talked about the listing process. What are, just to let the viewer understand, is what are the advantages that you may say from your side of listing?
By listing on the CSE.
Yes.
Initially I spoke about the value creation. To me, it's one of the huge advantages an unlisted issuer will have by listing the company on the CSE. Then main objective of listing is, of course, raising capital. You could raise long-term capital. You could raise capital for your long-term projects, because most of these issuers, I would imagine, they are reasonably well established, looking for the next phase of growth. So that's the time where you should go to the market and tap the investor base. You might argue that there are other options. As I said earlier, we want to be the preferred choice. So that implies that there are other choices, but we want to be the preferred choice. Of course, bank loans are available, but it's not advisable to have your capital piled up with debt capital, because it has certain disadvantages. Your future financing flexibility will be impacted, and your gearing ratio will be there will be adverse effects. So what we are saying is, you should have an ideal mix of both equity and debt in your capital. So that's the time you should go for a new listing to raise long-term capital. Then there are other, I'm sure this would have been discussed in previous programs also. You could offer once you are listed, you don't have to use cash to acquire other companies. You could always give shares of your company and acquire the other company. That method is quite popular in the Western world. I mean, recently, the best example, Facebook is going to acquire WhatsApp, and I think they're paying the consideration part in cash, and the bigger part is in terms of shares. Very popular method. Of course, you can retain your staff by offering an ESOP scheme, so that there will be this share owning culture created within the company. So it's a compensation given in the form of shares. And also there are other advantages, like once you are listed, you are open to a vast pool of investor base as opposed to unlisted. There will be foreign investors, institutional investors, retail investors. You could tap all these investors when you get a listing. And the advantage there is, when you are unlisted, sometimes the ability of the company to grow is hampered by the capacity of the owner to infuse capital.
That's right.
Now that disqualification will go out once you are listed, because you are opening up to a vast pool of investor base. There are various advantages like that, but one big advantage in listing is not a one-off exercise. After listing also, if the company continues to perform well in the market, and if the company is giving solid returns to the investors, you could always go back to the market and raise further capital. There are lots of ways of doing it. Last year, I'm sure the listeners would recall, John Keys Holdings raised 33 billion rupees by a rights issue, which is the single largest secondary offering rights issue amount raised by a issuer. So like that, it's not a one-off exercise. You could always go back to the market. Now, I'm sure all of us can discuss various methods of listing further shares.
Certainly, because obviously what you're saying is you go through the one-off pain, perhaps, of going through the IPO, the prospectus, valuations, and your fresh. You perhaps would have thought it's complicated, worried about various regulatory requirements. But once you go through the pains of listing, other than what you mentioned, obvious value creation, there are a lot of other benefits that come in. And what you just mentioned was the time capacity to go back to the market again. So what are these methods of
basically listed companies can actually benefit from their listed status, and in fact in the rule itself, the rules have identified certain methods as to how they can benefit. One is a rights issue. For an example, if a company has a particular project to carry out, then going to a bank and getting a loan for that project and paying interest on that loan, it will be cheaper for the company to issue shares to their shareholders and raise money for the projects. So that's a rights issue. Another method identified in the rule is a private placement. In the past, we've seen listed companies converting their loans into shares. Without paying the creditor money back again, they issue new shares of the company. So it's a private placement where they identify a particular person and issue new shares to that person. So that's one method. The other is an employee share purchase scheme. The rule encourages shares to be given to employees because it's believed it will be better for the employees and build their loyalty to the company.
And there's much more motivation involved in.
Yes, and ultimately the shareholder of the company benefits. Another method identified in the rules are a share swap. Here what happens is, if a listed company wants to buy shares of another company, then paying money for that purchase, they can issue new shares of the listed company. So shares are swapped between the two companies. No cash consideration goes. Also, there's a capitalization of reserves and scrip dividend, where the listed company can capitalize their reserves and issue new shares to all their shareholders. Also, another method in the rule is where the company can go back to the public, carry out an IPO, that's called a public subscription. After the initial listing, they can go back again to the public at large and raise money. So those are some of the methods identified in the rules, and I think Priyana will show you the statistics in the past as to how listed companies have benefited.
So here again we have the last 5 years statistics. As you can see, further issues have been a very popular method of raising capital even after the initial IPO. Last year actually the rights issues were less, but as you can see from the next slide, although the rights issues were less, the capital raised through rights issues, as Renuka explained earlier, is very high because there was one company that raised a big amount of capital. So even up to date in 2014, we have got quite a few applications for further issues. So further issues in the methods that Viduni explained are a very popular method of raising capital by listed companies. And if you just go into the amounts raised, as we mentioned earlier, this is the total amounts raised by the stock exchange for listed companies, and 68 billion raised via debt IPOs, 25 billion raised via rights issues, and altogether the stock exchange raised about 94 billion of capital in 2013. 2013.
Yes. Just one question for the companies who are interested in getting listed, and then for who wants to raise more funds through rights issues. Let's say somebody comes in for an IPO from 500 million and then gets on the main board. And next time they want to raise capital, like you said, they can have a secondary offering or offer it to their own shareholders, current shareholders, rights by way of rights.
Right.
So typically, how much can they raise from, say, an IPO which came at 500 million worth? Can they raise as much, or is it a percentage of that? How does that work out?
There's no restriction on there's no ceiling on the amount a listed company can raise. It depends on their financing requirements
and the project. And
exactly,
So as long as they have a proper valuation and a good story, they can raise as much on the secondary offerings also. That's
they should be able to convince the investors that they get a fair return which is higher than the cost of equity. That's the criteria.
So the dilution won't get affected to the current shareholders. I think we moved on to the continuing disclosures that's required. Anything that you want to add to that, what you already discussed?
Yeah, I briefly mentioned earlier, now every listed company has to issue the annual report to the shareholders and to the stock exchange. Priyana, would you like to discuss the details?
Yes, the annual report has to be in compliance with the Sri Lanka accounting standards, and within a period of 5 months from the end of the financial year, the annual report has to be released. Then also we have the interims that listed companies have to submit and disclose to the market as well. The interims, the first 3 quarters you can disclose in 45 days, but for the last final 4th quarter we give 2 months time. And that there again, these interim financial statements also have to be in compliance with Sri Lanka accounting standards. Then also we have the corporate governance requirements.
And just to get back to the financials. So what happens, for example, by any chance that a company cannot comply with the deadlines? How does that work out?
Yeah, so we would have a transfer to the default board after the deadline. We would
obviously
give them,
you all try to find out what this reason is.
Yes, of course.
And there generally is no, there shouldn't be a reason why they cannot file it. So you don't have that issue. It's not, you don't find that as a problem for companies, or they don't come up to you saying it's not enough time.
They might also they might have their own reasons, but we have been rather strict on that actually. If the deadlines are not met, we put them on notice and transfer the companies to default board. In fact, the market knows about it. So it's very rarely that you might find on certain occasions 1 or 2 companies getting into the default,
but they come back immediately. That's right. Okay, so as far as that is concerned, that is not a major challenge for most companies. Yes, please go on.
Yeah, so we have the corporate governance requirements that a listed company has to meet, where there have to be a certain number of non-executive directors. Say if a company has just 2 directors, both those directors have to be non-executive, or 1/3 of the board of directors has to be non-executive. Then coming to the independent directors, if there are 2 directors, both those directors have to be independent non-executive directors. If not, 1/3 of the non-executive directors have to be independent directors. Then we also have a requirement for the audit committee and the remuneration committee, where the audit committee and the remuneration committee have to consist of all non-executive directors, the majority of whom are independent.
So now from the discussion you would understand that our listing regime is basically based on disclosure.
That's right.
It's not based on merit. There are 2 types of listing regimes. We are not on merit. We won't say if a company tries to issue shares at 20 rupees, we won't say why not 15, why not 17. We don't go into that. But of course, we will get them to disclose everything about what the project that they are going to raise capital. And exactly. So there's a meaning to it now. So some of you might think that why are we having all these requirements, disclosure and all that. There's a very, very good reason for it. Apart from the fact that we are allowing companies to raise capital from the public, so that companies are answerable to public, it's their money that goes in. There is an issue about knowledge of information. Now there's in economics they call it asymmetry of information, because when in any transaction you have a buyer and seller, one party knows more information about the transaction than the other. Now for example, if somebody wants to sell a car, the owner will know much about the car than the prospective buyer. So there is a bit of a difference, a gap. So that gap remains even in this scenario, because the listed company is trying to sell, trying to create shares and issue to public. So public should know enough information about the company to take an informed investment decision. That's why we have all these disclosure requirements. The quarterly, as Prerna said, quarterly statements, the annual report, all these continuous disclosures. That's the meaning. It actually boils down to cost of capital.
Right.
Because the cost of capital
exactly.
The cost of capital for the issuer is much lower if you, among various other things, the more information you supply to the market, their cost of capital goes down, because then the investors can determine the correct price of the share because they have enough information. So that's the reason.
Right. So even other than what is required for financials, independently the company itself, suddenly they may have price or market moving information that they may have to come and announce.
Absolutely.
Plus any directors who are dealing with transactions has to be reported. How often and what is the requirement for that?
In fact, there are some new rules which are going to apply from next month on the directors' transactions. Currently the rule is immediate. Actually our rule is based on the Companies Act requirement. Under the Companies Act section 200, the directors' dealings will have to be anyway disclosed to the company. Now we have extended it by saying you disclose it to the market.
Right.
From next month, I think there are certain timelines which are
obligations on the director or the company?
The director has to first inform the board, and the company has to have internal mechanism where this information, because
it gets
that's also in line with this, insider information. Directors are insiders; they know much more than they know about the company much more than the others. So it has to.
That's right.
Director and the CEO as well.
Yes. There are lots of parties.
I think it's time to go for a break. We'll be back with a very interesting topic of the mechanics of listing on Going Public soon. Welcome back to Going Public. Here we are with the Colombo Stock Exchange officials discussing the mechanics of listing your company. We were on the topic of continuing obligations of a company once they have listed. Maybe Priyana can answer, or even the continuous obligation on the public float. I mean, I think you mentioned that on the main board you need to have 20%, or is it 20%? 20%. So what happens post listing?
Main board at the time of listing at the moment is 25%, but as a continuous listing obligation, the public float has to be maintained at 20% with 750 shareholders for the main board. And the Risavi, of course, same as at the time of listing, where 10% has to be maintained with 200 shareholders.
Okay,
but there are certain transitional provisions also applicable in the first 2 years. So the companies can meet with those transitional provisions in the interim and then comply with the main requirements later on.
Right. So this is an issue mainly, or is this actually an identified element? Is it because, for example, after the IPO, the company directors perhaps may go back and start buying in the public? Is that the reason?
We have noticed that because it was not strictly enforced previously. At the time of listing it was enforced, but afterwards, due to market activity, these percentages can go haywire, and you might have companies on the main board having about less than 5% public. So it's not actually, now there's a reason as to why we want this public holding component. When you are a listed company, there should be liquidity in the shares. Otherwise, there's no point in listing also, at least up to a certain level. Liquidity is very important because higher the public float, actually, liquidity comes from the public float, higher the public float, there's a higher chance of that company getting a good valuation. Usually there's valuations are high on companies having a large public float, because for the quality investors, for the long-term investors, the entry and exit becomes very, very easy when you have a higher public float. If you have a narrow public float, what happens is it becomes difficult. The impact cost will be high. So therefore what happens is, usually you will see the investors with short-term horizons or speculative elements entering into such shares, and as a result there will be a lot of volatility in the share. So narrower the public float, there's volatility. So it's like a vicious cycle. So that will further keep away the quality investors. So it's a disadvantage actually. That's the reason, and also to create liquidity. That's why there is a continuous requirement which has come in from this year to maintain the public float at this level.
So I would like to, of course, try to find out from the Colombo Stock Exchange officers who are here, how easy is it? How easy is it to do business with the Colombo Stock Exchange, first and foremost? If somebody wants to come in, how do you all assist this people?
Well, as you said, yes, all what we spoke today are in the CSE listing rules, and it's available on our CSE website, the rules. And apart from that, if the rules are too technical for someone to figure out, they can always call us, because we are very business friendly. I mean, they could actually ask us what the rule means, and we can interpret from our end. So, and also they could go to an investment bank, because it will help the process, because these people are more familiar with our requirements. They will help the company who is seeking a listing with documentation and what are the requirements that we want. So it will quicken the listing process basically.
Well, so you heard it here. Next time you want to list your company, you can always come and talk to Renuka, Vijini, or Priyana. They will help you and take your company public successfully. Well, back to you, Amaya. Thank you very much. Thank you.
What an insightful as well as interesting discussion, Vausala. I'm sure that answered some of the questions you may have when it comes to taking this next big step in the future of your company. With that, we are going to wrap up this week's episode of Going Public, but we will be back next week as well with another great episode. Until then, take care and have a great day.